I expect Bitcoin, it will appreciate about 30% a year for the next 20 years. And I think that if you look at it as an asset, the volatility is going to click down. It's gone from 80 to 70 to 60 to 50. The vol is going to go from 50 to 45 to 40 to 35 to 30 to 25. It's going to grind down towards something which is 50% more volatile than the VIX. The ARR is going to track the volatility. And so when we're 50 vol, we'll be 50 ARR, and then 45, and then 40, and then 35, and then 30, and then 25. And the terminal point, if you look 21 years out, is like 21% ARR, 21 vol. We're working our way there, and we're doing it with surges, up 40% and drawdowns 30%, and that serpentine climbing pattern.
When people talk about Bitcoin's volatility, they usually mean it as a red flag. Too risky, too unpredictable. But what if that volatility is just a symptom of something growing into its full potential? We're not watching a crash and burn story. We're watching the early stages of a global financial asset taking shape. The pullbacks, the rallies, the noise, it's all part of the story. Not everyone sees it, but the ones who do are playing the long game. Michael Saylor isn't watching Bitcoin like a trader glued to a candlestick chart. He's looking 20 years ahead, modeling the path of an asset that could average 30% annual returns while becoming less volatile each year. In his eyes, Bitcoin is on a predictable glide path, one where surges and drawdowns slowly level out as adoption spreads and markets mature. Volatility isn't vanishing overnight, but it's tapering off in a rhythm that mirrors every great asset class in its adolescence. This isn't about timing the market, it's about understanding where we are in the timeline. Saylor's message is clear. Bitcoin isn't becoming boring, it's becoming dependable. And for long-term thinkers, that's exactly where the real opportunity begins. Let's dive back into more clips from Michael Saylor, as he explains why Bitcoin's most misunderstood chapter could be the one that defines its future, and why the journey is only beginning.
When I got involved, I started paying attention in March of 2020. And if you remember what happened in March of 2020, I think Bitcoin traded from 10,000 down to 4,000 in one day. It was terrifying, but all the markets were terrifying. And at that point, I think looking back, Bitcoin had a history of more than 100 vol and more than 100% ARR. And later that year, it was sort of an 80 vol asset with an 80% ARR. And then every year for the past 5 years, it's sort of decelerated. It was a 70 vol, 70 ARR, and then 60. And then after about 5 years, it looks like about 50 vol, 50 ARR. And so 50 vol is still very volatile. It's still 3 times the S&P volatility. But believe it or not, it is actually seasoning, and it is institutionalizing at a reasonable rate if you just click off the volatilities in 10% increments. So if you look at Bitcoin, you're like, okay, this is a 50 vol asset, and it's got 50% ARR returns annual over 5 years. And everybody kind of knows that if you're going to own that, you need to hold it for more than 4 years. And I would say the natural duration is 10 years. Bitcoin represents a financial solution to someone that's going to hold the product for 10 years and endure a 50 volatility roller coaster in order to get really good returns. The world's full of investors that if I was selling a product like a car and I said, this is an electro-flying hover car and you have to buy it now, but you don't get to use it for 10 years. It wouldn't be an easy consumer product. Or I have this can of Coca-Cola. It's going to taste really good, but you got to put it in your refrigerator for 4 years, and then you can take it out and drink it. Well, I mean, there's a lot of people that want instant gratification. It's like, give me the car that drives now. Give me the fast food, right? So how do you actually strip the volatility, strip the duration, and compress the performance into something that a mere mortal can appreciate? And so the idea of digital credit is most people, they don't want to wait 10 years, to get an insanely good return. What they want is, say, a bank account that pays 10% without the volatility. Like, I put my money in the bank, they pay me 10%. That's better than 2% or 1% or 4%. So in order to create something which is which has got the volatility stripped off of it and got the risk stripped off of it, and it's got the yield distilled, and you convert it into the currency of choice. Like, I live in Japan. I want 8%. I want a bank account that pays me 8% in yen with a stable value. That would be a digital credit instrument in Japan. And that's something like, say, a MetaPlanet could create. And what we've created is products like STRC, which is a treasury credit instrument in US dollars. And if I have $10 billion of capital, Bitcoin, then that's going to be very volatile. You're going to live on that roller coaster, and you got to hold it for 4 years or longer. And again, ideally 10 years. But I can take $1 billion of my capital structure. I can create some credit instrument which is 10x over collateralized. And I can sell that in the market, and I can offer, say, 10% dividend yield. And I'm going to fund the dividend yield with the first 10% of the return of the Bitcoin. So I sell the $1 billion of credit. I buy $1 billion of Bitcoin. Bitcoin is going to do this. It's going to be a roller coaster for 10 years. The credit investor doesn't want that. The retiree doesn't want that. But the equity investor and the company can absorb that. We would like to collect 30% and pay 10. And we're willing to stomach days where we're down a lot or we're up a lot and smooth it over a decade. And the credit investors, like a 20-something in grad school, or they're a retiree, or they're a fixed income investor. So what we're doing as a treasury company is we are swapping stability and yield in dollars, or it could be in euros. We just created a digital credit instrument that pays yield in euros. We're swapping that in order to get the capital to buy Bitcoin, which is digital capital. And so at the end of the day, what you do is you create an equity instrument for equity investors that want amplified Bitcoin, that they want more volatility and they want more performance. And then you create credit for credit investors that want damped Bitcoin. They want, if I'm 10x over collateralized, I've stripped 90% of the risk away, right? Bitcoin has to fall by 90% and I'm still collateralized. So I've stripped 90% of the risk away. I've stripped 90% of the volatility away. I'm not giving you the 30%. I'm giving you the 10%, but that's totally fine, because if you walk down the street and you ask 100 people, do you want to buy a really killer, complicated digital capital asset you got to hold for a decade to get, insane returns? Or do you want to buy a bank account that gives you 10% without that volatility? Most people want the 10% bank account powered by digital capital rather than the 30% ARR on the volatility roller coaster. And so the digital credit idea is you serve all constituencies. But by the way, there's three. If you don't trust anybody, if you just want to own the crypto asset, the commodity, you buy Bitcoin. And then if you're an equity investor and you want to buy a company that's on rocket, it's a rocket ship or the jet engine on, or the roller coaster, then you buy the equity. And if you're the credit investor and you want a comfortable retirement and Social Security, then you buy the credit. And that way everybody's getting what they want out of this trade. I think the most exciting, there are a lot of ways you can create value from capital. For example, banks use their capital to create consumer credit and commercial credit. Insurance companies use capital to create innovative insurance, life insurance, health insurance, car insurance, reinsurance, different types of insurance programs. But a treasury company, like a Bitcoin treasury company or a digital treasury company, the most compelling thing is to create digital credit. And right now, you've got 3 companies that have been leading the way. Our company has created 5 digital credit instruments, and probably the flagship is Stretch, a variable rate monthly preferred credit. Think of it as treasury credit or a high yield bank account. Strive created a product called SATA, S-A-T-A, which is sort of similar to Stretch. It is also a treasury credit instrument, that pays these dividends. They're ROC dividends, return of capital dividends, just like Stretch pays these return of capital dividends. And return of capital dividends are very cool because they're tax deferred. You get paid the dividend. There's no capital gains tax or income tax on it. You just reduce the basis in the instrument, and so you're getting a huge amount of cash flow. And then there's a third company, Metaplanet, and Metaplanet just created a digital credit instrument called Mercury, which was convertible preferred. It's very similar to what we did first, called Strike, STRK. And Metaplanet announced Mars, Metaplanet Adjustable Rate Security. That will be a treasury credit instrument in yen. So you have those three examples of companies that are creating adjustable rate digital credit instruments, treasury credit instruments, all powered by Bitcoin. They're all going to pay much higher dividend yields than your money market or your bank account could. They all work well for the treasury company, because if you're a digital treasury company, you want to generate BTC yield for your equity investors.
Most people want the returns of Bitcoin without the turbulence. The answer? Break it into parts. On one side, you have the raw asset for those with iron stomachs and long-time horizons. On the other, digital credit instruments offer stable, attractive yields backed by Bitcoin's power, minus the chaos. It's like turning a roller coaster into a smooth train ride. You still get to the destination, but now everyone from retirees to risk-averse savers can come along for the journey. Most people want yield without risk, upside without chaos. That's where digital credit steps in. By using Bitcoin as over-collateralized capital, treasury companies can offer stable, high-yield instruments that feel more like savings accounts than roller coasters. While ETFs just hold, these firms create, credit, equity, and capital products tailored for all risk appetites. It's a financial revolution powered by Bitcoin, but delivered in a form even your grandma, your toddler, or your future trust fund can use. Let's watch more clips from his interview.
What is the motor to create shareholder value if you're the treasury company, right? And the motor is to sell digital credit. When you sell $100 million of digital credit and you buy $100 million worth of Bitcoin, you're creating a $100 million Bitcoin gain for the equity investors up front without any shareholder dilution. And then you're creating a high yield bank account for the credit investor via that swap. And you're using the digital capital as the collateral in order to strip the risk and the volatility off of the credit, which then makes it appealing to the risk-averse credit investor who would never, ever want to buy the underlying commodity. They just couldn't handle the volatility. And there's no yield in Bitcoin, and there's a lot of vol in Bitcoin. And the world's full of investors that don't want the vol, and they do want the yield. I think I'm not going to tell you what every treasury company or what every digital asset holder should do, because in theory, you could accumulate $10 billion of Bitcoin and you could write insurance policies with it. Or you could you could also loan out the Bitcoin, to another counterparty. So there's a banking model, there's an insurance model, but I personally believe the most compelling business model is the treasury model. And the treasury model is I raise capital and then I create credit and I sell the credit. I sell public credit. I sell an STRK or an STRC via an IPO on NASDAQ. It's publicly listed. It trades, like STRC is trading hundreds of millions of dollars a day. And it's a global credit instrument that provides liquidity and yield and lower volatility and less risk to a different set of customers. And I think, not to wax philosophical on this, but if you think what's the perfect product, is the iPhone the perfect product? iPhone's a pretty good product. It made Apple a $1 trillion company. But I think the perfect product is I give you a treasury credit instrument that pays you 8% more than the risk-free rate in the currency that your expenses or your obligations come in. So if I give you 8% in yen or 10% in euros or 10% or 12% in dollars, then I'm giving you this massive high yield bank account. You don't need to be able to read. A 3-year-old would get value from it. An 80-year-old would get value from it. If you're in a coma, you would get value from it. Right? Your unborn children will get value from it. The trustees, the foundation, it pretty much is the gift that keeps giving, right? It's such a good product. The reaction of anybody would be, well, what's the catch, right? And the catch is, well, you need a dynamo to power the dividend, and that's digital capital, Bitcoin. And then you need to trust the creditworthiness of the issuer. So you want to create a digital treasury company that's got very transparent credit, that's got a lot of collateral, that is understandable, that acts in a very predictable, transparent, consistent fashion over time, and that's what makes you credit worthy. And that is, I think, the digital credit revolution. If you were a holding company, okay, well, so you have $60 billion worth of Bitcoin, you're an ETF. What are you doing? Nothing. Okay, that's a holding company. If you're an ETF, that's what you are. If you're a closed-end trust, then you have 60 billion, but you can't redeem it. And there's no way to you can't even arb the security to get to NAV because you don't have the ability to trade. When you're an operating company, you can create convertible bonds, senior bonds, asset-backed securities. You can create preferred stocks. You can do IPOs. You can sell the credit. You can buy the credit. You can sell the equity. You can buy the equity. You can sell derivatives on the equity. You can sell derivatives on the commodities, right? You can sell the commodities. So operating companies have a lot of financial flexibility. And maybe the most important point to make is, if I want to create an instrument where I strip 90% of the risk and 90% of the volatility off of the Bitcoin and give someone 10% yield in dollars, you can't do that with a closed-end trust. You can't do that with a private fund. You can't do that with an ETF. You literally have to have a publicly traded operating company, in our case, a well-known seasoned issuer. And that means a company that can create a public security, file the registration statements with the SEC, and take it public and list it on the NASDAQ. And if you look at STRC right now, STRC is trading more than $100 million a day. That is 100 times more than the average preferred stock. That is 1,000 times more liquidity than the typical over-the-counter preferred stock issued by a public company. And of course, private credit you've never heard of because it's private. That's the whole point. I think that's really hard call right now, given the volatility we're seeing today. So I don't think I can give you a short-term answer. It could be really anywhere. I can give you my view over the long term, which is I expect Bitcoin, it will appreciate about 30% a year for the next 20 years. And I think that if you look at it as an asset, the volatility is going to click down. It's gone from 80 to 70 to 60 to 50. The vol is going to go from 50 to 45 to 40 to 35 to 30 to 25. It's going to grind down towards something which is 50% more volatile than the VIX. The ARR is going to track the volatility. And so when we're 50 vol, we'll be 50 ARR, and then 45, and then 40, and then 35, and then 30, and then 25. And the terminal point, if you look 21 years out, is like 21% ARR, 21 vol. We're working our way there, and we're doing it with surges, up 40% and drawdowns 30%, and that serpentine climbing pattern, as we work our way toward, global adoption. I'm clearly most enthusiastic about digital capital. I think Bitcoin is digital capital. And I'm second most enthusiastic about digital credit. So the credit instruments that digital treasury companies like Strategy, Metaplanet, and Strive are creating. And then I'm third most interested in digital equity. That is the equity in a digital treasury company in the business of creating digital credit. So it's digital, 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 depending on whether you're a credit investor, equity investor, or capital investor.
Bitcoin and Ethereum are stuck in tight trading ranges, and while that may seem dull, it's actually the kind of setup that often precedes explosive moves. The market is quiet, volatility is shrinking, and both price and behavior are coiling around key levels. Traders who chase every candle are finding little reward, but seasoned eyes know what's building here. Historically, these compression phases don't last. Liquidity accumulates, pressure builds, and then one clean breakout flips the entire mood. We've seen it before, and we're likely to see it again. This moment ties directly to a key thesis presented by Michael Saylor. Bitcoin is maturing. What was once an asset swinging wildly with 100% volatility is now settling closer to 50%, and he expects it to grind even lower over the coming years. That doesn't mean Bitcoin is getting boring. It means it's becoming foundational. As volatility compresses, Bitcoin shifts from speculative chaos to structured capital, capable of supporting sophisticated instruments like digital credit, equity, and yield-bearing securities. For now, this calm is not for guessing, but for preparing. Smart investors are watching resistance and support like hawks. The next move won't be subtle. Once either Bitcoin or Ethereum breaks and holds, volatility will return fast and hard. Until then, the best strategy is patience, positioning, and clear-eyed focus, because when this market wakes up, it won't wait around. And those who confuse silence for safety are often the first to get caught flat-footed. As we wrap up, where do you think Bitcoin is headed next? Breakout or breakdown? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching, and don't forget to subscribe.